Good afternoon, East Tennessee, and you're tuned into the Organized Investor Show right here on your radio dial. And I got to be honest with you guys, today's show, well, it is an intervention, a loving, well-intentioned, financially motivated intervention. It's me, Ainge, former Tennessee Volunteer quarterback, former New York Jet quarterback, and current host of this program. And I'm joined today by three people who have spent decades helping folks in this region figure out actually what's happening with their money. Let's start with Megan. Megan Hubbard, former first grade teacher, now, without question, the most patient educator in financial radio. We got Jerry Goodman, 43 years in the biz. He's seen every market cycle, every crisis, every crash, every variation of human financial behavior imaginable. And my beautiful wife, Susan Ainge, and she is studying for her Series 7 securities exam, which means mostly not hanging out with me at the house. Today, we're going to do something special that we've never done before here on the Organized Investor Show. We're going to go through the top 5 reasons people do not call us, rate them, answer them, and then gently embarrass you into picking up the phone, again, with love.
Thank you, Eric, and a hello to everyone listening. I am Megan Hubbard, and I want to add something to Eric's setup. So in my years of teaching first grade, the most dangerous words a child could say were, "I already know how to do that." And then you just know that's where things are going to go downhill. So because the kids who said that were almost, never the ones who actually knew how to do it, it became a challenge. They also were the ones that were a little bit scared to find out that they actually didn't know how to do it. And I'm not saying our listeners are, 6-year-olds, but I am saying the psychology is pretty similar. It's kind of identical. And we're going to deal with that today.
So I am Jerry Goodman, and I'm not 6 years old either, but I'll just add this. Over 43 years in this profession, I've had thousands of conversations with people who would say, I wish I'd called sooner. At least that's what most of them will say. I have never, not once, had a conversation where somebody said, I wish I'd waited a little bit longer before I called you. Not one time has that happened. So that should tell you something, folks. So let's get into this, guys.
And I am Susan Ainge. So I will say that studying for the Series 7 has given me a very specific appreciation for just how much information most investors simply do not have access to. It's not that people are making bad decisions. It's that they are making decisions without the full picture. So that is what today is all about. Giving you the full picture and then handing you a phone number.
All right, so before we get into the excuses, let me give you the scoreboard. It's my favorite part because in my experience, nothing shuts down bad excuses faster than verifiable numbers. For the calendar year 2025, the accounts that Jerry and Jared manage at Tennessee Wealth Management averaged a net return of 36.3%. The Dow Jones Industrial Average was up 13% that same year. 3-year average is 19.3% versus 13.2%. 5-year average, 13.3% versus 9.4% for the Dow. And the 7-year pacing, guys, 16.7% annually versus the Dow at just 10.1%. Those numbers are posted publicly on the organizedinvestor.com with the last 4 digits of actual client account numbers so anyone can verify them. And they are net of all fees. Nothing is hidden. Nobody's making them up. All right there.
And here's the part of the performance conversation that I think is most important for people to understand. These results, they're not coming from a mutual fund selected by a committee in New York City. They're not coming from an algorithm. Jerry, my dad, and my husband Jared, they are making every single investment decision themselves in-house at our office with full visibility into every account. When an opportunity appears, they act on it, sometimes within hours, which is kind of annoying because if I need, to talk to them, they're not really around. They want
not
to...
now.
Leave us alone, Megan.
Exactly. So they don't wait for approval either. They don't have to submit a request to a compliance department 3 states away. They are able to move. That responsiveness is not a small thing. It is a very large part of why the numbers are what they are.
So let me give you one piece of context on the performance because I think it explains not just the past, but also the future. Right now, this team holds approximately 95 individual stocks, 1% invested in each one of those, okay? Not 500 companies, not 3,000, 95 carefully selected companies. When you calculate the average analyst price target across all 95 of these positions, the number is 39%. Now compare that to the S&P 500, where the average upside potential is currently at 19%, okay? 19% is less than half of that 39% number. So if you're wondering, how does this team consistently outperform the market? selectivity is the answer, okay? We don't own everything. We own the right thing.
I want to make sure that 39% versus 19% really lands, because it's not abstract. If a stock is trading at $100 per share today, and analysts who study that company full-time believe it's worth $140, we refer to that as having a 40% upside. So now flip it. If a stock is trading at $100 and analysts believe it's only worth $90, you should not own that stock. It's already $10 overpriced. But if you own the S&P 500 index, you own all of those companies, the ones with real upside and the ones that are already overpriced. So they average out. An average, as Jerry has said many, many times, it's just a polite word for mediocre. And we are not in the mediocre business.
No, we're not. Right here in the middle of segment one, exactly where we promised, let me tell you about something that could genuinely change your financial life. Every month, the team hosts a free Organized Investor Workshop at Chesapeake's Restaurant right there, Parkside Drive in Knoxville. Starts at 6 o'clock, and there is no cost and there is no catch. You will receive a 60-page workbook, a wonderful meal, possibly an adult beverage or two, and a complete walkthrough of everything that we do for our clients: investments, tax planning, estate planning, the whole picture, and you get to hang out with us. I think we're a pretty fun group. You also learn how to get a complete package of estate planning documents through Trust and Will at absolutely no cost, no obligation.
Seating is limited, so reservations are required. You're going to visit the workshop page at theorganizedinvestor.com to make your reservation there, or you can call 865-415-2058. And one lucky attendee at every workshop actually wins a full-size Tennessee football signed by Erik.
Hut.
And your hosts will be myself, Megan, and Susan, Jared, my husband, Jerry, my dad, and sometimes Amber, our operations manager, is able to join us as well. So we would genuinely love to see you there.
And one small footnote, when you all said there's no catch, actually, that doesn't include the fish because it is a seafood restaurant, folks. So, all right, time to get into the excuses. I know it's a bad one. Get into the excuses Hall of Fame. Excuse number one, and the most popular by a wide margin: my guy's been with me for 20 years. Now, let me respond to that one very carefully because I understand why it feels like a very valid reason. Yeah, loyalty matters. Relationships do matter. But here's a question no one ever asked. Loyalty to whom? Okay, not who, but whom. You know, if anybody's been managing your money for 20 years and their annual return is average, let's say 8%, while our clients have been averaging over 16% across that same 7-year stretch, you know, the math on $1 million on all that difference, it's staggering.
We are talking hundreds of thousands of dollars in foregone gains that you earned, that were available, that just went somewhere else. Your loyalty is admirable. And the price tag for that loyalty, well, it is not.
And I want to add something to that. There's a difference between your advisor being a good person and your advisor delivering good results. Those two things can both be true. He can send a lovely Christmas card and still be leaving money on the table. You know, she can remember your grandchildren's names and still have you in 15 mutual funds and cost you more than you realize. We're not asking you to stop liking your advisor. We're asking you to look at the scoreboard, because the scoreboard does not care how nice somebody is. It only shows the score.
Excuse number 2 is my personal favorite because it's the most honest excuse on the list, really. I think I'm doing okay. Notice the word think. Not I know I'm doing okay, not I've verified that I'm doing okay, but I think I'm doing okay. That is the financial equivalent of, walking out of a doctor's office and saying, I think I'm healthy, without having any tests actually done or talking to your doctor about your health. You might be right. You might also have something fixable that you only can discover if, you let somebody actually look at it.
We have a couple retired teachers we met not too long ago. Both wonderful people, 18 years with the same advisors, thought they were paying 1% in terms of the fees and the cost. We did a Morningstar report for them, and after we ran that, they basically realized they were paying closer to 2% when you add in the advisory fee and all the internal costs of the mutual funds, okay? On their $800,000 portfolio, that's $16,000 a year in total cost, okay? So the wife looked at us and said, that's our entire annual vacation budget.
I want to go on vacation with them.
Exactly. The partiers, aren't they? So we've been handing our vacation to Wall Street for 18 years, and we don't even know it. They thought they were doing okay, and they were, just not as okay as they could have been.
Excuse number 3, I do not want to be sold something. We completely understand this. The financial industry has earned a lot of skepticism over many decades, and walking into a financial advisor's office, it can sometimes feel like walking into a used car lot. But here's the reality of how this team operates. They charge a fee to manage your assets, and they're not going to suggest some other product in order to make more money. There are no commissions. There are no revenue sharing arrangements with mutual fund companies where certain funds get recommended because they pay the advisor to recommend them.
The only thing on the table is an honest assessment of your situation. And if you come in, you look at everything and you decide to stay where you are, nobody's going to chase you to your car. No one calls you 6 times with information you didn't have before. That's it.
All right. Excuse number 4 is I already have an advisor. Yes, most people do. That's not the question. The question is whether the advisor has ever shown you their actual verified track record against a real benchmark. Jerry says it all the time. You didn't make 8%. 16% was out there. You lost 8%. That conversation. Has your advisor ever shown you every dollar you're paying in fees like we're talking about? Not just the advisory fee, but the hidden internal costs inside your funds that never show up as a line item on your statement. Have you ever stress tested your portfolio against what would have happened in 2022? If the answer to any of these questions is no, then you have a professional relationship you have never actually evaluated.
You would not keep a contractor for 20 years without checking the quality of the work, right? But somehow, with the most important financial asset you will ever have, people just assume it's fine. And it may be fine, but you don't actually know that. And not knowing is really the whole problem.
So, excuse number 5, I just wait until things kind of calm down a little bit. Now, Erik, as a quarterback, he kind of learned very quickly that if you wait for the perfect moment to throw the ball, you're never going to throw it, okay? The pass rush, it doesn't calm down. The coverage, it doesn't just simply take care of itself. You read the situation, you find the openings, and you act. The market was never, not once ever in history, officially calmed down. Volatility is not the exception, folks. It is a condition that comes with it.
Ooh, I like that quarterback thing right there you just did, Jerry. All right, coming up in the next segment, we're going to share 2 investment opportunities we're working with for our clients. And they exist precisely because things are not calm right now. The noise is the signal. The chaos, it's the opportunity. When we come back, we will show you exactly what we mean.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend, however, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
And welcome back to the Organized Investor Show on News Talk 98.7, brought to you by Tennessee Wealth Management. That's us right here talking to you about money. If you just tuned in, we spent segment 1 dismantling the 5 most popular excuses people give us for not calling. None of them survived the encounter. One of them actually fell over before we even finished the sentence. We buried it with dignity.
So for anyone joining us, here are the numbers worth repeating. So in our calendar year 2025, we managed 198 client accounts with an average net return of 36.3%. Our 3-year average, 19.3% per year. 7-year average, 16.7% annually. And all managed in-house by my dad, Jerry, and my husband, Jared, with no committee, no algorithm, no mystery.
So these are actual numbers, okay? Nothing exotic, nothing borrowed from some sort of marketing brochure, just what happened when you read the balance sheets instead of the headlines. And when we make decisions, they actually go through to humans who own the outcome, okay? Not a committee 3 time zones away who you have never met.
Well, Jerry, I love how you specified actual numbers as opposed to the other kind. Is fake numbers a thing in this industry now?
Or just no numbers, right?
No numbers is more like it.
If so, we've been missing out on a much easier way to do this job. Imagine all the printer ink we'd save.
All right, so how does the average investor consistently end up with average results? We got a word for it, guys. Said it before. We're going to say it again. Diversification.
Dun, dun, dun.
Not a typo. Diversification. Diversification, no, that's good. Diversification. We invented the term, and we're pretty proud of it, and Jerry wants it printed on a business card someday.
Here's what happens. Most advisors drop their clients into 15 or 20 mutual funds, and each fund owns hundreds of companies. Do the math, and you end up owning 3,000 to 5,000 individual stocks. Congratulations, you now own the entire market. By definition, your returns become average.
Diversification. Now, try saying that fast 3 times, okay? I actually don't. You might pull something, Erik. But the concept is real, okay? Diversification goes too far. It stops protecting you and starts dragging you down. You become the market, and the market basically by design delivers exactly market returns. That's what it does.
And the part that stings the most, you are actually paying for the privilege. The advisor charges around 1%. Then each mutual fund has its own internal expense ratio, another 0.5 to 1%, that never shows up on your statement. It just quietly vanishes before your returns ever reach you.
On $1 million portfolio, that is $5,000 to $10,000 a year. Every year. No bill, no notification, just gone. Like your car keys, except it's your retirement. You're paying a premium to get average returns. We call that creative pricing for obvious reasons.
So let me sit on a number that people always underestimate. 2%. That is our stated goal, improving clients' performance by just 2% a year. On $1 million portfolio, that is $20,000 a year. That sounds nice, right? Pays for a good vacation, maybe 2 if you pack your own snacks.
Would be. Now, here's the kicker. Compounded over 20 years, that 2% increase, it doesn't equal 20,000 times 20. No. When you actually do the math and compound it, it ends up being $485,000, again, when compounded. Now, on top of that, this is on top of what you already are going to earn, okay? And this is arithmetic, not magic.
And if 2% sounds too small to chase, try saying that sentence out loud in 20 years when it is $485,000 extra dollars in your account. Still sound small? I didn't think so either. Compound interest does not care about your feelings.
And that 2%, it's not magic either. It's 3 things working together, all right here. Lower advisory fees, about 0.25% less than most advisors. No hidden fund costs because we own individual stocks. And better performance through selectivity. 3 ingredients, 1 recipe, 485,000 smackers.
Which brings us to selectivity. Instead of thousands of stocks across 15 mutual funds, most of your accounts are invested in about 95 individual stocks, roughly 1% in each. Every holding has been analyzed. Earnings, balance sheets, business quality, competitive positions, and most importantly, price compared to fair value.
Now, in reference to what Megan just mentioned, that's the current allocation. Sometimes it may go down to as little as, say, 20%, which we were recently in terms of the allocation because we were trying to be more conservative. Now, on average, each of these 95 stocks is followed by 22 analysts setting different price targets for them. So if a stock trades, let's say, at $100 a share, and the analysts collectively think that should be, say, $130 a share, let's call that a 30% upside potential. So we're going to let hundreds of these researchers do the heavy lifting for us. It's really pretty glorious.
Across our 95 stocks, the average upside potential is 39%. Across the 500 stocks in the S&P 500, it is only 19%, less than half. Which portfolio would you rather own over the next 12 to 18 months? Don't answer that out loud if your current advisor is in earshot, by the way.
Or do, and then call us. Here's another one. If our 95 stocks all dropped to their 52-week lows, that would be a 19% decline. If the S&P 500 did the same, it would be 25%. Our upside is roughly double, and on the downside measure, we're about a third less. The math can help you sleep at night.
And a great company is not automatically a great investment. Being selective is how we averaged 16.7% annually over 7 years.
And this is my part. I like this. Okay, remember, guys, past performance does not guarantee future results, and returns vary by objective and risk tolerance.
Thank you, Erik.
Hey.
7 years of 16.7% annual returns. That's not luck, folks. Luck can wear out after time. Luck doesn't show up like going through COVID, the banking scares, the tariff panic, the AI sell-offs that we're going through right now, even this little conflict we have going on with Iran, okay? That takes discipline and coffee sometimes, although I don't really drink it. You know, we should probably also mention the coffee.
Speaking of things we want you to take seriously, the Organized Investor Workshop that we hold every month at Chesapeake's on Parkside Drive, right here in Knoxville, 6 p.m. It'll cost you absolutely nothing. You get a 60-page workbook, a great meal, and possibly something cold in the glass for you.
You can hang out with us. You also learn at the workshops that we do, you learn how to receive a complete set of estate planning documents through our partnership that we have with Trust and Will. Wills, powers of attorney, healthcare directives at no cost, no obligation, the kind of documents that could easily cost several $1,000s at an attorney's office or otherwise. And one lucky attendee wins a full-size Tennessee football signed by me, complete with a stand so it doesn't, roll off. You can put it right there, statement piece,
And
Erik
it's a cute
Ainge
football,
autograph.
too.
It's clearly the coolest reason you should come.
Very attractive.
Seating fills up fast, so reservations are required. You're going to visit the organizedinvestor.com, click the workshops page, and grab your spot. Or just call 865-415-2058. The hosts of the workshop are Erik and Susan Ainge, myself, and my husband, Jared Hubbard, and Amber DeLong sometimes if she is able to join us. And then, obviously, my dad. We can't leave him out. We've tried, and he still shows up.
Might even bring our dog.
Mo.
And dress code? Well, whatever you want to wear, or maybe you just wear your pajamas so you go straight home and you just get in bed.
Get a
You
good
don't even
night's
have
sleep. You just learned how to change your financial future.
It'll be a
Hey.
slumber seminar. How about that?
Exactly.
Okay. So in addition to our core holdings that include stocks with a history of raising their dividends over a long period of time, we also look for what we refer to as bargain opportunities that will occasionally appear in the market. Now, we took advantage of some of these little opportunities back when COVID was around. Remember that fun time, 2020. We had the banking crisis in 2023, the tariff scare last year in 2025. At the moment, we're in the middle of two new opportunities, which basically is a bit unusual. Bargain opportunity number one is what we're going to call an AI panic sale. So for over a year, the market has convinced itself that artificial intelligence is going to destroy an entire software industry. Every software company out there basically has gotten priced for the apocalypse.
And the fear is real. AI will change plenty of things, but the reaction has been widely overdone. Quality software companies with real revenues, real customers, and real competitive moats have been punished right alongside the companies that might actually have a problem. The market does not sort. It just sells.
And that's why we went shopping. It's one of our favorite things to do. The 25 software companies we currently hold have an average market cap of $42 billion each. These are not obscure startups that we found behind a dumpster. The average analyst upside across these 25 positions is 78%, roughly 4 times the S&P 500. When the fear fades, and it always does, those prices drift back toward fair value, and that's where the gains arrive. We're not predicting the exact week. We're just playing the game where the math is on our side and the clock is ticking in our direction.
Bargain opportunity number 2 is the Iran situation. So more recent, more event-driven, and uncertainty hit specific sectors almost immediately. Cruise lines, airlines, travel, leisure. These companies did not change, fundamentally, but fear just hit the sector and investors sprinted for the exits like somebody yelled free coffee in the parking lot.
Exactly. Now, meanwhile, oil stocks shot up because the conflict in the Middle East tends to do that to that group. So here's what we did. We bought 3 cruise lines, 4 airlines, while the fear was the loudest. And we also sold a bunch of oil stocks while they were running up. So, in other words, the old expression, buy low, sell high, actually does work. Now, when the uncertainty finally resolves, and it, again, as Erik mentioned, it always does, oil pushes back down, travel recovers. This is not a prediction. This is a pattern that has repeated itself every single situation in recorded market history. Not most, every single time. So when you see it coming, you position for it.
And this is what active management actually looks like. So about 6 months ago, we pulled clients back to 20% equities as markets got uncertain. And then we went right back up to 95% when real opportunities showed up. Try doing that with a mutual fund or a committee or a brochure.
You can't do it. Everybody says buy low, sell high. Your grandmother knows it. And yet nobody actually does it because buying low means buying when the news is terrible and people are scared. And selling high means selling when the news is great and people are greedy. Both feel wrong emotionally. Your stomach votes no every single time. Well, Jerry and Jared, they're not your stomach. Jerry and Jared have spent years training themselves to do that very thing that feels wrong emotionally, but it's right mathematically. 36.3% net in 2025 is what it looks like when you let arithmetic drive and emotions ride in the backseat.
Speaking of emotional resistance, let me tell you about James. So 71 years old, when he walked into our office, he had been with the same financial advisor for nearly 30 years. They played golf, they went to the same church, and he considered the man a genuine friend and by all accounts, a really good person. But when we ran James' Morningstar report, his 5-year return was around 7%. During that same period, our clients were averaging over 18% annually. On his $600,000 portfolio, the difference between 7 and 18% was tens of thousands of dollars every single year for 30 years.
So when we showed James the numbers, he went very quiet, did the math in his head, looked at his wife. Then he looked back at us and said something that none of us really was ever going to forget, okay? And it was honestly, you might want to sit down for this part. He said, I compare gas prices. I drive across town to save 10 cents on a gallon of fuel. You know, I stand in the cereal line and look at 10 minutes, but for 10 minutes at a box of cereal or something. You know, $4 Cheerios versus a $3 store brand. You know, I clip coupons for things that I don't even need.
And he also said, I never, not once in 30 years, compared my financial advisor to anybody. I have been assuming I was doing well because I had nothing to compare it to. That word, assuming, 30 years of assuming, which when you actually think about it, it's a really expensive word.
That is exactly why we show people their Morningstar report. Not to embarrass anyone, because you can't improve your situation that you don't know exists. If that story makes one listener pick up the phone today and ask for their own free Morningstar report, then we've done our job and we're doing what we're trying to do right here. Well, James, guys, he did make the switch. He's now retired and traveling with his wife to places they'd put off for years because they weren't sure that they could afford it. Turns out they could. They just didn't know it. And they've been making up for lost time ever since.
The friendship with his old advisor, by the way, survived completely. They still play golf together. James just doesn't pay him $24,000 a year in advisory fees and hidden fund costs anymore. I guess they can go play golf more now, right?
Yes.
The friendship was real. The fee equation was not.
So the lessons of James is not that his old advisor was a bad person. He was not. The lesson is that comparison is a gift, not a betrayal, okay? You compare gas, you compare cereal, you compare cars. Comparing advisors, it's not being disloyal. It is being responsible and might even be kind of overdue for many people.
Which brings me to the part where we tell you exactly what happens when you call, email, or walk into our office. 4 things: no cost, no obligation, nobody chasing you to your car with a clipboard, just a conversation. And these 4 freebies that are generally worth your time.
The number one, we just talked about it, that free Morningstar summary report on your current investments. It's a 100-plus page independent analysis showing you what you own, what it really costs in actual dollars, and how it's actually performed compared to real benchmarks. Not our opinion, Morningstar's numbers. Independent, third-party, zero spin. Number 2, you get a free retirement cash flow analysis. That shows you if you're on track for your retirement for what you actually want, factoring in taxes, inflation, Social Security timing, and your real spending, what your plans are. It's not a generic online calculator, okay? It's a real look at your situation with real numbers, and it's genuinely very useful.
Now, number 3 is the complete set of estate planning documents through our partnership with Trust and Will. We have basically an unlimited subscription on an annual basis for them. It can include wills, power of attorney, healthcare directives, all those fun documents. These kind of documents would probably cost several $1,000s if we're done in an attorney's office. For our clients and workshop attendees, there's no charge, nothing sneaky, nothing extra. Just give us a call and we'll help you get going with it.
Oh, and number 4, guys, you can't forget this, full-size Tennessee football signed by me, yours truly. Jerry keeps telling me that this one is not as important as the other 3. I think he's wrong. The football on the stand, it's really, really important.
So here's your homework. Seating is limited, so reservations are required. Visit the workshops page at theorganizedinvestor.com or call us at 865-415-2058. And one lucky attendee at every workshop wins a full-size Tennessee football signed by my husband. Your host will be myself, my husband, Megan, and Jared Hubbard, Jerry Goodman, and Amber DeLong. We would genuinely love to see you there.
And if you're still on the fence, here's my honest advice. Run the numbers. Not our numbers, your numbers. See what you're actually paying in fees. What are you actually earning and what 20 years of compounding looks like on your real portfolio? You know, the math will tell you what to do. The math's going to math.
The math will math, and the Organized Investor Show will continue. When we come back for segment 3, we're going to talk about the one excuse people never actually say out loud, the quiet one, the one that keeps people stuck for years. And then we'll hand you back your afternoon with a little more math in your pocket than you had coming in. It's the Organized Investor Show right here on News Talk 98.7.
If you're interested in a more personal learning experience, join us at the Organized Investor Workshops. Erik, Ainge, and the entire team will be there. The next event is scheduled for Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show, brought to you by Tennessee Wealth Management. For our final segment today, it's me, Ainge, with my wife, Susan Ainge, Megan Hubbard, Jerry Goodman, all right here. A quick summary of the journey so far today. Segment 1, we went through the 5 most popular reasons people do not call us, and we dismantled every single one of them. In segment 2, we showed you the math behind the performance, explained the concept of diversification and why selectivity matters, walked you through the 2 live bargain opportunities happening right now in the software and the travel sector related to Iran. We shared James' story, 30 years of assuming everything was fine and the cost of that assumption. This segment is for, quote, the last excuse, the one no one says out loud, and then we're going to give you every tool you need to actually do something about it today.
Brief numbers recap for anyone just joining us. So for 2025, we had 198 accounts with an average net rate of return of 36.3%. For the last 3 years, they've averaged 19.3%. And over the last 5 years, we've made 13.3% per year. And our 7-year annualized net rate of return was 16.7%. So all managed completely in-house by Jerry, my dad, and Jared, my husband. And at this point, their current 95 stock portfolio has a 39% average upside potential versus 19% for the S&P 500 index. So 2 simultaneous bargain opportunities: the software sector oversold on AI fears and travel stocks discounted on Iran uncertainty. We also covered the 4 completely free things waiting for anyone who calls or attends a workshop.
So let's talk about the last excuse, which basically will allow people to not pick up the phone and call us, okay? The last excuse, I'm probably too late, okay? The last excuse is the one that people, they're going to feel it, but they're never going to say it, okay? It goes something like this. Well, I've been listening to the show for a while, and I know I should have called, but I haven't, okay? And the market's probably already moved, so I'm probably too late. Now, we understand the feeling completely because no one wants to, show up after the party already gotten over, but just in case you haven't heard what we covered in the last segment, most of our accounts consist right now of 95 stocks, 1% invested in each, and the average upside potential is currently at 39%, okay? That means that if all 95 of these stocks were to move up to their price targets set by these various analysts around the market, it would be a 39% increase in current value, okay? Now, by comparison, the average upside potential for all the stocks in the S&P 500 is 19%, which is basically less than half of where we're sitting with our portfolio.
Here is what is objectively true right now. We have 2 active bargain opportunities in progress. Not in the past, not hypothetically, active right now. The software sector has been pricing in an AI catastrophe for over a year, and quality companies are still trading well below what analysts believe they are worth. The travel sector is still discounted on geopolitical fear with Iran. The window's still open. What would actually be too late is sitting here 12 months from now, watching those price targets get hit, watching these software companies and the 7 travel stocks recover to fair value, and saying, I really should have called. Well, that is the version of too late that actually hurts.
So let me chime in once again and make a point about how we materially improved the financial lives of clients, for so many clients, I should say. Now, our fees are about 1/4 point less than what most advisors charge. We avoid mutual funds basically because they're expensive, they're over-diversified, and they usually have mediocre performance. We invest, in contrast, in higher quality companies, usually with a history of raising their dividends. That's a big core part of what we do. But we also invest in bargain opportunities with stocks when they do exist, which has been very, very profitable. So we manage these accounts in terms of selection and trading, completely in-house by myself and my son-in-law, Megan's husband, Jared. And oh, by the way, Jared is a practicing CPA. He's married to Megan, and he's also in charge of doing all the actual trading and the transactions that take place in these accounts.
So we have access to a massive amount of research through our clearing firm, which is Wells Fargo Clearing Services. And we've had some very impressive performance with other bargain opportunities involving COVID in 2020, the banking crisis in 2023, and the tariff scare in 2025. The most recent opportunity is a 2-for-1, which includes the AI disruption overreaction and the war with Iran, both of which should be able to prove to be very profitable. As we said earlier, the average upside potential for the current 95 stock portfolio is at 39%, which is actually double the upside potential for the S&P 500 index. In the spring of 2025, we realized early on just how much money our clients were going to make during the tariff opportunity. And yes, the average return for 2025 for the 198 accounts managed was 36.6%. We don't know how profitable these two current bargain opportunities are going to be, obviously, but the calculated upside potential of 39% is a great place to start. So we're excited for our clients to be in this position.
I want to hold up a mirror for just a moment. No, not to look at myself. I'm doing this with complete affection for our listeners. It needs to be said. This week, just this week, you probably noticed when the price of something like a loaf of bread went up 50 cents. You may have spent 10 minutes in the cereal aisle comparing $4 box of Cheerios to the $3 store brand and the $2.79 generic. Drove 10 minutes out of your way to save a little buck, to save a few dollars on gas, right? You have a coupon app on your phone. You're standing there in the aisle to save 75 cents on peanut butter.
Or you negotiated with the cable company for 20 minutes over a $12 monthly charge. But your retirement account, the one with $300,000 or $600,000 or $1.2 million in it, you have not looked at it since the last time something in the news scared you. I'm not saying that that's wrong. I'm just saying the math is lopsided in a very specific direction.
So let me put some numbers to that mirror for you. The average listener to this show probably has somewhere between, $500 to $1.5 million in retirement assets. Let's just go with those numbers. A 1% improvement in annual returns on $1 million portfolio is $10,000 per year. 2% improvement is $20,000 per year. If you were to compound $20,000 over the next 20 years, it's equivalent to $485,000. That's not a small amount of money. That's not the price of a box of Cheerios. That is a second home. That is 20 years of annual vacations. That is, every grandchild's college education paid for. And the people who are leaving it on the table are the same people who are comparison shopping over paper towels. Now, we're not judging you for that because we do that too, right? It's important to still pay attention to things like that, but it's more important to pay attention to your investment accounts. And so we're just asking you to apply the same careful attention to the bigger number.
So I want to share one more story because I think it's a perfect illustration of what is possible on the other side of the phone call, okay? Carol, she was 68 years old, and basically she'd retired. When she'd been with the same advisor for like 15 years, never questioned it, never had and made a comparison. When we ran her Morningstar report, her 5-year rate of return had basically been around 6%. Now, she looked at the comparison for just a moment. Then she said, I've been paying fees for 15 years, and no one ever showed me this. No one ever compared my results to anything. I feel like I've been basically kept in the dark. And sadly, she was. Not maliciously, but pretty much completely. That's where she was.
Carol is now a client, and within the last 8 months, her returns have improved dramatically. But here's part of the story that I think matters most. About a year later, she called the office to tell us that she had taken her grandchildren on a vacation she never thought she could afford. It was a full week at the beach, all expenses paid by Grandma Carol. She said, I spent years thinking I couldn't do things like this. It turns out I just needed someone to show me what was actually possible. And that call is why we do this. Not the performance numbers, not the track record. Carol at the beach with her grandchildren. That is the point.
I need to find myself a Grandma Carol.
Yeah, me too.
Yeah, beach sounds fun, guys. But let's bring it back to segment 2 real quick, and let's sharpen it a little. When the news broke about the Iran situation, and both the cruise lines and the airlines dropped a lot, Jerry and Jared had positions in 3 cruise lines and 4 airlines within days. When oil stocks ran up on the same news, they sold their oil holdings because those gains were being driven by temporary fear, not by business improvement. Now, I want to ask you a very specific question. Can your advisor do that? Not can the concept of an advisor do it. Can your person that, we talked earlier that you love in your account with your money, pick up the phone and move that at that kind of speed with that kind of precision when the opportunity appears? If you are in mutual funds, the answer is structurally no. You're a passenger. You can't do it. And your advisor is not the driver. You may not even know what road you're on. The mutual fund moves when the committee decides it moves.
And this is the part of the mutual fund conversation that actually never gets discussed on the brochure. So when you own a mutual fund, you own a portion of a basket. You can't, adjust the basket. You can't say, well, keep the airlines and sell the oil. You can buy the whole basket and you can sell the whole basket, or you can just sit there. Those are your three options. And that inflexibility, that inability to respond to the market, the way a surgeon maybe would respond to what, is actually happening in the operating room, is one of the primary reasons that over 80% of actively managed mutual funds underperform a simple index fund over a 10-year period. And, that structure defeats the strategy every single time.
So one more invitation, one more time in the middle of this segment, because we really mean it, folks. The Organized Investor Workshop, Chesapeake's Restaurant, Parkside Drive, 6 o'clock in the evening every month. No cost, no catch, except for the fish. We talked about this earlier. Great food, 60-page workbook, estate planning documents free of charge through Trust and Will at no charge at all, plus that autographed football by Mr. Ainge. Okay? So this is about 2 hours. It could genuinely change the direction of your retirement, of your long-term financial future. So seating, as you might expect, is limited. Reservations are required, and you can either do that at theorganizedinvestor.com or give us a call at 865-415-2058. We've made this as simple as possible, folks, and the only thing that's left to do is what you can do.
Another option is just call Jerry for what he calls Ask Me Anything in 20 Minutes chat. His phone is 865-415-2070, and that does ring directly to his cell phone. So assuming his phone doesn't identify you as a spam call, he'll do his best to answer it. He'll answer all your questions, and then he'll invite you to either come to the workshop, come by the office, go to lunch, whatever you want to do. The bottom line is he can't help you if you just listen to us and then never reach out. So again, Jerry's phone number, 865-415-2070.
All right, and I want to start closing us out with something that's genuinely true and genuinely important. This team has 2 active bargain opportunities right now that they believe are among the most compelling that they've seen in years. They have a 7-year track record that is publicly posted and independently verifiable, theorganizedinvestor.com. They manage every account in-house, know exactly what they own, and have the flexibility to act on opportunities like the ones we're talking about in real time. They've made 4 things available for free. They run a monthly workshop where you can come ask anything face-to-face. And they have shown up on the radio program every single week to give you information that most advisors guard carefully because, well, it doesn't serve their interests for what they have in mind for you. They've done everything on their end. The only thing left you can do is make the call because we genuinely do not know who you are. You're listening right now, and we want to help you. You're somewhere in East Tennessee right now, maybe in your car, maybe in your kitchen, maybe out for a walk. The only way you're going to benefit from any of this is if you get in touch with us.
So I'm going to ask you one more question before I hand you back your day. What is the cost of not calling? Not the emotional cost, but the actual dollar amount. Because if the team's current 39% average upside potential plays out even partially over the next year or two, the software and travel opportunities recover toward fair value. The gap between being in these portfolios and being in a typical advisory account is going to be very real. It's going to be very measurable and irreversible. You cannot go back and claim the gains that you missed. You can only decide from, today forward that you're going to take advantage of the opportunity. So today, right now, is the best possible day to call 865-415-2070.
And thank you for spending your time with us today. I'm Jerry Goodman, and I hope this conversation will give you either some clarity or basically a mild productive embarrassment to take some action. See, both outcomes are wonderful. Both lead to the same place. We'd love to sit down and see you at our workshop. We'd love to prepare a Morningstar report that can actually give you some insight as to how much improvement might be possible with your situation. And we'd love to be having a different conversation with you 6 months from now, okay? And the one where we basically showed you just how far things have come.
On behalf of the entire team, thank you all for listening today. Past performance does not guarantee future results, and we will always say that. Also, investment returns will also vary depending on the investment objectives and tolerance for risk for each individual account. Folks, we have a 43-year commitment to doing this work with integrity. That one we will stake our reputation on. 865-415-2070 will put you in touch with Jerry. Call anytime, and yes, he answers his own phone. In this industry, that alone should be worth something.
Hey, it's me, Ainge again. All right, here we go, guys. The best financial decision most people in East Tennessee could make this week is a 20-minute phone call to this team. The numbers back it up. The track record backs it up. 2 bargain opportunities currently in play makes this both not only important, but very timely. Hope you have a wonderful day, everybody. We'll see you back next week. It's the Organized Investor Show on News Talk 98.7, brought to you by Tennessee Wealth Management.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes. Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, May 20th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend, however, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.